Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Friday, July 5th, 2024. So the markets are in the final trading day of an abbreviated week. Of course, they were closed yesterday for the Independence Day holiday, and then truncated trading day on Wednesday. So again, volumes low this week. It's a holiday week. That's typical. It's can't remember a 4th of July week that we didn't see very low volumes. But what I'm going to do here is that I'm going to cover the usual suspects, the things that I am personally trading and focused on now and been highlighting as trade ideas. Starting out here with silver, only because I didn't include this chart in that last update. We were a little hair shy of T2 at the time when the update I gave you today when gold and silver hit their next price targets. And I wanted to reiterate, because I did follow up in the comment section under that post. We just hit, or right when I screenshot it, we've now hit T2, and that was my sole and final target. Remember, that was especially for you, those select handful of traders on this that follow the site that seem to only trade QQQ. Again, till I'm blue in the face, I got to say, if you're not diversifying your trades, good luck with it. There are traders that only trade Bitcoin or only trade the stock market or only trade gold bugs, but these alternative assets have far outperformed the market even recently. I quoted as a 9% gain. You can see here we had 2 entries on that, and that was after shorting it off the down move here off the highs and covering it. So you take that was a 10% drop. And then the last 2 updates, one I got off to before I went on vacation right here, saying silver offered an objective low there at the 26.38 support, positive divergence and trend line. And then the next one was right after that. We were still at the horizontal support level, holding that 26-ish, support, with the divergence even bigger that time. And again, same 2 targets, 26.46, 28.66. And so now that's it. Boom, we just hit 28.66 for I think it's a full off that low 10% gain. Now, that's it. That was the final target. I maybe mentioned earlier of adding additional targets. I'm not interested in gaining additional targets now, so I've closed out my silver trades today and do not plan to hold out. I told you on Wednesday I closed out my TLT trades. We had a little more upside on TLT, and I had that's moved. I had one contract, single ZB contract, and one IRA account I missed last week. So that I closed out today, but that was a tiny amount compared to what I had hedged up in my trading account. So that's your update on gold. Oh no, that's not the full update. I just wanted to cover the gold. Yes, I gave you for ETF traders. Remember, there was a short here with 4 targets, hit the 4th and final target to the button there, reversed it, hit T1 here, hit T2 today, took it out. We're a little shy of T3. Just my thoughts. We may continue higher. This could be the road to new highs in gold, but again, we milked the bulk of that. And as I often say, to be bullish or long gold is to be bullish or long GDX or SLV, silver or silver futures. You just get more bang for your buck. So you can see it was half the rally. It was about a 4.5% lift off that entry there in the divergent low in gold. And as I just mentioned, it double in silver. Like I said, you're either going to be right or wrong on your trades on the call for gold and the metals, so why not get paid for it? And then same thing here. I got that post out to you this morning. We were a little shy. The final target I had at GDX at the time, but this is why I do these long-winded videos, cover multiple charts, whether I'm trading the indexes, and then I watch if I'm trading QQQ, I watch SPY. I'll also watch Apple, Amazon, Microsoft, the big names, because if you have any one, or especially the majority of those coming to support or breaking above resistance at any one point in time, it's most likely going to spill over to the rest of them. So this was a good example of I posted there covering the GDX short after boom, 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 coming off that divergent high and bearish rising wedge, reversing it long. And so if you did so, you got paid about also 10%. So it's lightly, and that's typically, I always say, gold and silver and GDX tend to go up in a multiplier of gold. It's not a fixed formula, but here it was pretty fixed at a 2-to-1 ratio on the two. So that's it. And again, that was also, if you go back to that chart I posted back then, you can see the highest target I had was 36.21, and that's it. So now, two ways to trade this, guys. There certainly could be a case to be made. We're in a near-term uptrend. You get these divergent lows after the recent, remember, going back a few months ago, gold broke out to new all-time highs, a major resistance level. So the case can be made, if you are bullish, that you buy these 60-minute after you get a correction off of a divergent high on the 60-minute chart. You go long into divergent lows, and quite often that's the catalyst to the move to next high, next run to new highs. Me personally, again, they were both pure play longs and indirect hedges. They were initially done as pure play longs, but it's a lot about this too. If you recall, when covering the euro-US dollar pair, trading, swinging these divergent lows, highs, or using this more so as a, to confirm or refute a long entry in gold. In other words, you want to be ideally the best trades in gold and silver. You want to align with a bullish setup in euro-US dollar. So that was the first time. I just showed you the charts. We went long gold and silver back there. And not mere coincidence that it made an equal and still divergent low with just bigger divergence, the euro did, at that second point that silver and gold did, and especially silver when I showed you the 2 equal lows, and then boom. Now it's also not random that we hit that 108, 334 target that I've had on this chart for weeks now. And so we could go more, but like I said, we're at resistance. And swing trading is all about. You get a double-digit gain in a few weeks, depending on what you're trading. Of course, take the money and run. Or, like I said, if you're bullish, think there's more, just raise your stops to protect profits. It would be insane to give back a 10% profit. So where you raise them is up to you. That's simple. The wider your stops, the less chance of getting stopped out in a corrective move or a stop raid. But then you're giving back more in profits. Tighter stop, it's going to have a higher probability of getting clipped out in the noise, but it's also going to help protect profits. How you trade, that's up to you. Okay, we're going to work our way up to the markets here. Wanted to just talk about some of the other, like I said, trades that are correlated with the stock market, because the stock market, first and foremost, is highly correlated to the euro and US dollar, meaning this chart shows you euro up against the dollar, so it's dollar down when the euro is going up, and so you can trade this one or use it to help align your trades with the equity market. So again, stated last week or the week before, started throwing out some what I called indirect hedges for any positions short the equity markets, and with the point being that Treasuries, if the market rallied, Treasuries would rally most likely, and they most certainly have. Crude would likely go down. Now, crude, I'm going to get to that in a second. I still very much like it. We still haven't broken that trend line support that we need to break to take that to an even bigger position, in my opinion. But we're right there now. I just want to show euro, US dollar, because that also affects all these things: gold, silver, even Treasury bonds. So TLT was the trade, if you will, when I have confidence in the move there, or want to. It's same story with gold and gold versus silver. You can trade the 10-year bond. You can trade the 5-year if you want. Or you trade the 30-year bond. The longer the maturity in the bond, the higher duration. Duration is a bond's move in percentage points to a change in interest rates, or how much a bond will move in relation to a change in interest rates. And so the 30-year bonds just have more juice, if you will. And so that was it. So we went long right there on the uptrend line support. We hit what I showed you last week. Maybe it was, must have been futures. I gave you a couple bounce targets, and that one we hit them both right there. And so you can see right now there's a potential downtrend line that may come into play here. Made clear that this one I wouldn't short last week, but now I am considering reversing a trade on there. I told you I closed out on Wednesday, removed basic book profits on it, on the bounce target, removed the hedges. And I think there's going to be a pullback here, probably at this downtrend line resistance. I'm going to go over a couple more charts here. Let me just show you. Keep in mind this one here, IEF. IEF dipped back into the orange zone. It was literally the day after I posted that, or the day of, that I actually said, although that should be net bearish for the stock market, however, that also went long. Treasury bonds expecting a bounce for the aforementioned reasons, and therefore the bounce in bonds, like I said, if the stock market were to go higher, and I certainly have those ranges I'm going to cover in a second, which the probability now of going to the top of the range has increased. As I said, that would go up in a linear fashion if we took out the bottom of the range, which it has so far. I'll get to that one second. And so we're still in that yellow zone, meaning yields are still elevated to where they've been, in recent years with this whole inflation trade. Remember, Treasury bonds down near their low means yields are near their high. This is just the yield of the 10-year bond in reverse, and that's the daily chart. So I've been focused on the 60, but way back when I created these zones, I mentioned that there's two components. There's a function of price, pure levels, which again, you're looking at the price of bonds as I draw these arrows, which is moving inversely to their interest rates. And so lower bond prices means higher rates. But the other function here is time. Because of the debt wall, they call it, a tremendous amount of corporate debt with an average maturity somewhere around the 5-year mark. We went from a zero rate environment where they had ultra low rates. We're coming up on that. It's a known fact. I don't think anyone knows exactly the amounts each month that come due, but we know it's starting between now over the next year or so. A lot of companies will be rolling debt. So therefore, it's the two factors are how deep we go. Now, if we turned around and went into the red zone right away, yes, I have a super high degree of confidence. What I said back then, the stock market would start to freak out. We've remained above that red zone. We're flirting now. We've been moving back and forth, as you can see, between the orange and the yellow zones. And but also the longer you stay here elevated in these, yellow, especially the orange zone, then again, it's a function of time, because every single day, as time goes on, more and more companies, as well as individuals looking to buy cars, finally selling their homes with their low mortgages, are going to move into the higher rates. So it's generally accepted now. People realize in the stock market realize these, there's this false belief out there that rising rates don't matter anymore because they haven't mattered yet. Well, again, it's been documented, missed by myself, a lot of others, how long the lag effect would take due to corporations and individuals locking in. This is unprecedented, the amount of homes that haven't turned over. We had that plunge in home sales. Nobody wanted to give up the 2.5% and to 3.5% mortgages. So those people are still in there, but gradually they die. They have to move. They get relocated at work. Their insurance, we're seeing now, is skyrocketing, so they can't afford that, and they're forced to sell. And so we're going to gradually see that happen, and then more and more people give up those, 3% mortgages and roll into the 7% mortgages. And so the corporations, it's the same way. So just remember, this is not this more so, the levels right now to me are more of a timing indicator, if you will. I talked about that repeatedly in recent months, that when we entered the orange zone before, that's when the stock market had the biggest correction all year. As I mentioned, time, that was back in April. And so there are the absolute levels, but again, we've been in the orange zone, we've been chopping around. So at this point, what matters, if we continue down towards the bottom, we take out those lows. That would be obviously a level to watch. See the 10-year take out that previous low from April and then get into the red zone. As of now, we're just kind of going around sideways. I don't have a strong opinion on bonds. I'll let you know. I'm going to look at a few more charts right now and tell you if I think it's worth a shot. Let's go to ZB. Yeah, no, I can't make a strong case. I'll just hold off for the moment, most likely. I'm looking at, it's a pretty decent resistance level. Remember, these are all resistance levels and potential targets I gave you when we went long right here off the lows. A target in the downtrend line is the preferred target there. And that's CB, that's the 30-year. So, to see whether it's worth, that's a 6-month chart with 2-hour candles. You jog down to a short term, like a 15-minute chart, and then you can see we're almost divergence there. We do have divergence on the PPO, almost an equal high there, prices making a higher high. But what I can tell you is there's also a trend line to watch right there. You can draw that trend line. A little bit steeper trend line coming in a little above there, and this would be, I can tell you right now, a push up to 119.073 would be a better, more objective short entry if you're looking to game a pullback on treasuries. So that's ZB, that's the 30-year. ZN is the 10-year. Again, you get more bang for your buck trading the 30, but the 10 is most important to the financial markets. There's a potential uptrend line. So we're at that downtrend line I gave you in the last update right here. We are at downtrend line resistance. I don't see any super well-defined price resistance. I might be able to take this downtrend line over. Yeah, I can, all the way up to this high. So that's a pretty significant resistance level because it comes all the way back in at this trend line. Remember, that's a 2-hour candlestick, 6-month chart going back. That trend line starts in early February, end of January right there. Let me jog it down to a 15-minute chart just to look. And you've got the similar comparable divergences there. And then if you trade the ETFs, well, there's IEF, which I already covered there. 15-minute chart. Yeah, there it is. So, again, I'll say what I said on Wednesday before the markets close. I think it's, if you took it recently at the recent lows, again, it was TLT. And that was your plan to take either trade a quick bounce, get a few percentage points. Remember, it's a 2-time plus beta adjusted trade, meaning you take double the size of the equity market. So this silver, they've all outperformed the stock market as far as both either indirect hedges by far, or they've worked out as good pure play trades. But the RR isn't very good now. It's kind of a sloppy-ish chart right now at this point in time. So again, if nothing else, if you want to just let it run, especially if you're going to by the same logic, I'm going to get to the equity markets in a second. If you took this or still have it as a hedge, if you're holding on to some index shorts, then this is still a hedge for the same logic. If the stock market goes up, treasuries are likely to go up as well, because falling yields, meaning rising treasury prices, will help support that scenario. And now we're over the 50-50. Remember, last week, I told you it was about a 50 coin toss odds nearly on whether we're going to go up to the top of the range, my bounce target range, and then those odds would go up incrementally if you got into the range. So we're there. I'll get to that chart in 1 second. Let me make sure I covered everything in this sphere: the metals, the treasury bonds. Let me do crude and nat gas real quick, because crude more so is the indirect hedge as well. Crude, this is USO, the ETF right there. There's your uptrend line that's comparable to the one I gave you on the futures. Same divergence right there. And crude's just kind of hanging in there in the last week or so. I told you I took that one as also an indirect hedge, shorting crude instead of going long. Remember, it was going long metals, going long treasuries, but yet short crude. Crude is also, and I feel very strong, this worked out perfect last time when we entered in April. Got into the top of the orange zone. Stock market and crude had the biggest drop in all year. And that will most likely be the case again. This is almost, in my opinion, a nearly immutable negative feedback loop I've talked about many times over. The negative feedback loop between commodity prices, i.e., which is inflation, particularly crude oil. Remember, a bushel of wheat can go up 20%, but it's not going to immediately increase the price of a loaf of bread, which goes in the CPI. Then again, a loaf of bread is going to have a small impact on the CPI. Crude oil has a very big impact, and I'm going to get to housing in a second with the housing stocks too. That has a big impact, but either way, you cannot argue on USO. That's a big level. It's also the bottom of the red zone, and again, last time we kissed the bottom of the red zone, it's showing you here the drop in USO, because these two also go hand in hand. The stock market rallies when crude goes up, because there's that typically, not always, but typically, the increased demand. If this market's rallying, people are spending more money. They're going to vacation. They're traveling. They're getting in their little SUV, traveling up, I-95. They're jumping on planes, going down to the Caribbean, Italy. I can tell you, was shoulder to shoulder pretty much trying to, do the usual stuff, the tourist stuff there. So, God, we only did those for a couple of days. But So that will rising stock market, people's 401ks swell, they take vacation, and crude goes up. Likewise, when the stock market drops, there's the implied demand destruction, and crude goes down. So there's been that very tight correlation, and hence a short on crude is a indirect hedge to a long or a short on equities. In other words, they should go up and down together. So to be short equities right now and short crude, well, again, I'm viewing that as an indirect hedge, and I'll show you where it's, we're pretty much right where it started it last week. Let me find my CL chart 1 second. Yeah, so it's right here, and we're right there. This is the trend line I told you I need to see break, and then that is a kind of what I call an all-in, take it to a full position short on crude oil. Just a beautiful setup, that big negative divergence, building, walking up that trend line. This is the trend line I was referring to last week, earlier this week, and boom, we break that. There's your targets, 1, 2, minimum target right there. That's the first target, but I think we'll come down at least there, and quite possibly all the way down. That's why I've listed these multiple targets. And again, that should, if QQQ is going to go, and QQQ and or SPY going to go to the upper ends of those bounce targets, not bounce targets, they're maximum rally targets. And again, they're not too further overhead. I think 4% or less right now. Then this, I think, is just a nice indirect hedge to that. So that's it. Last time we had the divergent high, as I pointed out before, these lines keep going away every time the futures roll. Right there, we had that drop from that previous divergent high. And again, it's not the divergence, it's the sell signal. It's the trend line break, which you got there, and then the back test, and then you got all that. So there's your update on crude. Natural gas, still liking for the reasons I mentioned just the other day, Wednesday, I believe it was. We have big positive divergence forming. Natural gas has had a nearly inverse relationship with crude oil recently. So crude looks poised to break down soon below that trend line. And if so, crude will start to fall, and then that gas is likely to follow. I can tell you we're not sort of in no man's land. There's not really great support. I can force some lines right here. I don't want to force those lines. This is the next big support if nat gas goes much lower. But again, these divergences have been building. And once those happen, you usually are followed by a trend reversal, just like you had a divergent high here. You had a divergent high there, a correction, divergent low, rally, divergent high, correction. And that's the update on natural gas. And again, it tends to move inversely to crude, and crude looks poised for a trend reversal here. All right, the other ones, and let me just do this. Let me get two things, two other items. I'll do an update on soybeans, then the home builders, and then that'll segue us into the stock market. Okay, ZS are your soybean futures. As pointed out the other day, we hit the first target. Now we've taken that out. Remember, first target's also resistance, 11.26 and a quarter. Therefore, that should open the door, up to a move up to the next target. You have an uptrend line potentially forming here. So any pullback to that level would also provide an objective re-entry, add-on, new entry. When is it not objective? Usually, once you get up, of course, if you get towards this final target. This is a final intermediate target. As I've covered before, the longer term charts also look very constructive of these grains. So I'm very open to adding additional targets if and when we start to get up to T4 on CS soybeans. And if you trade that was futures. If you trade ETFs, then SOYB, I gave you that's for your ETF traders. ETN, technically, exchange traded note, coming off a big support zone, divergent low, positive divergence, and this makes the case. And these are still the same targets from before. Remember, we actually went long here and hit our first target, which was an objective time to pull out. It was a nice run up in soybeans. This is just a pullback, and then the next leg up. Since we've already hit and had several reactions on T1, that increases the odds that we may just go on through there next time and continue to these next. Again, these are much deeper targets. And so this is a daily chart. So it shows higher targets than what I was showing you on that 60-minute chart of the futures a second ago. And then the grains tend to move together. That's wheat, corn, soybeans. And this was that downtrend line on wheat, which taken out, back tested. Wheat's at that first target or first resistance level, still coming off an ADL, what I call an ADL, almost divergent low, because it was divergence. We had equal lows there in the PPO. I was going to say slightly lower lows on the RSI, but not really. If you look at it this way, you've got some divergence right there on that final last thrust down. So either way, trend line taken out, and you need to pop this level and pop that one, and then that could take us up for the next leg up. And it's most likely, again, because of the birds of feather flocking together thing, corn, wheat, and soybeans. But as I mentioned back a couple weeks ago, soybeans was my favorite, and you can see it's outperformed the other two. So at some point, if soybeans gets up enough, I'll start rolling some, taking profits out of that, maybe moving it over to some of these other grains. All right, let's do home builders. Okay. I noticed home builders hit my initial targets today. Let me tell you what I'm talking about first. We'll go to ITB, and we'll go back to this video I gave you back on March 28th, and I followed up several after this, a couple days later, and pointed out as far as sectors, home builders as one of the best looking shorting ops. I'm just going to hit, you can see we're about 42 minutes in the video. This was XHB. Let me zoom in a little bit, and you can see 96.93 was my first target there, and we are at XHB. Oh no, I'm sorry, ITB. There's two of them, ITB and XHB. ITB has a little bit more concentration in the actual builders. They both, what I mean by that is, they're the home builders ETF, home construction, but they have Home Depot, Lowe's. Obviously, Home Depot and Lowe's aren't home builders. They're retailers, right? Sherwin-Williams are not a home builder. It's a paint company. They're in there. You have companies like Fastenal, companies that make anything due to the home building index. But you have the builders mixed in there. So that's it, guys. We have now hit that initial target right there. These are just micro targets I added since right here. All hit, reactions on each one. Now I want to point out we have almost a divergent low. We have a slightly lower low, but close enough to say that there's positive equal lows there in prices. Either way, it's a good support level. Now it's one that I believe a sector that like many has peaked. And what is that? That was when was that video? That was back on March 28th. So we were right there. That was the day of the highs right there. Yep. And I did that video on the exact day that the home builders peaked. And so that's good for a 16% drop. We're at the 200 days. What's going to happen? They're probably going to come in here and buy the home builders, right? You can bounce, game it back to any of these resistance levels. However, because the 200-day moving averages are important. That's the price support level, same target laid out back the day they peaked. And they're likely to come in and buy it. However, I think that level will ultimately break. Again, the market's within now spitting distance of my max upper range. And if and when that breaks, I'm going to give you one more level here. These were old lines. I'm going to pull this. These were old targets. We shorted the builders back here. We hit T1, 2, 3, 4. Never made it to T5, but I commented on them at this time with a positive divergent low. We got out of those, closed it out there, at least expecting a bounce. So I'm going to move these. I'll leave those lines there for that moment. I'll clean this chart up later. What I need to do is add one right here. This was a major high, that divergent high we shorted them off of. And so it's a thin zone right here. If you look at my volume and price histogram, I don't know if you can see it in the video. There's these green and red bars that come out like this. And then here they're real small. And that's comparable. It's what I call a thin zone where we didn't gap, but it's almost like a gap. Very few trades through there. So this is key support. 200-day moving average, 200-day, both exponential and simple moving averages, those blue and red lines. Price support that I was targeting back there, hit. So again, bounce or no bounce, if and when that level goes with conviction, that's going to be bearish. Anything other than one day, brief whipsaw, it gets back above there, and then that would bring in more downside. Builders, if you look at it from a long-term perspective, they're just coming off this massive divergent high. That was the trend line break there, the wedge break. And so it's just kind of a lot of thin air there. And again, this speaks to the stock market. This is the home builder sector. Let me jump back to that video real quick and show you. I'm just going to hit the play button here from the 42.56 mark around the 43-minute mark. You can see a counter. I run into XHB and gave you my targets there. 97.38 was my first target. So I'm going, and that's during the video, just showing you the wedge, beautiful bearish rising wedge, negative divergence. Again, that's just the draws going on in the video, taking us down to at least that target there, 97.38. I'm still drawing here. Let me just jump forward. And XHB, that was then, this is now, it's bigger picture. That was a daily chart in the video. 97.38 to the button, folks. In fact, we hit it. We hit 97.38. Low of 97.50 on what was that? Tuesday. Yep, Tuesday. Today we hit a low of 97.40. Close enough for government work. 2 cents off. So consider that a hit. It's at support. This is where they will likely buy it. You've got the potential divergence here, clinging by the skin of its teeth, but you have higher highs in the indicators and slightly lower lows and prices. I'm sorry, that's the divergence line right there. So 2 things. Number one, if you happen to take that short and you're still short, I would cover the short now. At the very least, I would set a tight stop to protect profits if you think we're going to break and go down to the next targets. But ultimately, bounce or no bounce. And again, I do favor a bounce. But bounce or no bounce will probably come on down once that level in the 200 days go all the way down here to 85.15. So again, the takeaway for this is not just to update those previous trades, and there were several updates since that last video, the day they peaked, but also to say this is a state of the housing market. Yes, these are the builders, but what's going on? And again, and during that video, I talked extensively how I track and still do Redfin, Zillow, Fred, the St. Louis Fed's website I have all kinds of real estate economic indicator charts. And so the housing market and stock market are by far pretty much the only 2 pillars of consumer confidence. Stock market being everyone's 401ks and their portfolios and IRAs, and then the housing market. And the housing market is clearly turned. However, you don't have real-time data on the housing market like you do on the stock market. Stock market tick by tick. You can tell it's going up, it's new highs. You can know that everybody is happy in their 401ks, and then boom. So housing market, in my opinion, has peaked and rolled over, again, as evidenced by this drop in the builders. And we'll see most likely, which we'll get to here in a second, the stock market to follow. I just wanted to reiterate both those targets to the button have been hit now from the day they peaked, and that's already happened. So yeah, even if we bounce, that's already a double-digit drop in the builders, and it's just another sector that has long since rolled over. So we've still got tech holding things up. Now we roll into that, and we go to QQQ. We go to we can look at it on the weekly or daily chart. This is the weekly chart here. Before we do that, let's go back to this post from a couple weeks ago. This is the SPY, QQ, NVIDIA long-term price targets. Again, I had done a video earlier that week and identified these targets that I feel they're just, I think, just solid targets. You're going to have a little flexibility on the range, but QQQ, top of the market range, being about 511, 5, we call 510. I played around with these fibs. It runs anywhere from about 510. I had a 511.74, and most importantly, here again on the weekly chart. Again, this is how they were posted back then. Here, let me get to the updated chart. But that's what it looked like on Q, SPY, and as I said, we were only about 5.5%. With the top of the bearish engulfing candles from a couple weeks ago, 5.5% to that top of that range. So it's a relatively tight range. Again, small range. NVIDIA, same long-term targets. Let me just jump to the current charts and show you where we're at. So QQQ, this is the weekly chart. Again, I've been updating this on a regular basis. We haven't taken this trend line out yet, and I'm going to jog this down to a daily just to show you. You can see a little bit clearer daily chart. I got to go to board 8. So we've entered that zone, and as I said the other day, we were at, it was at near coin toss odds at the bottom of whether that would turn down there or we'd run up to the top. And the way it works, and hopefully this makes sense. So the odds here, when you enter the zone, they don't start at 0 and go up to 100%. You get to 100% means you hit it, obviously. And so it's I think linear odds, if you will, not exponential, just linear. Every tick you go up, starting at 50%. So it's 50-50 odds whether we were going to turn down here or go up here, and obviously anywhere in between. So what happens when you pop into it, the odds, as I mentioned the other day, increased above 50%. We are a little higher today, so it's a little higher now. So we'll call it, I don't know, 58%, whatever. There's no matter what, whether we go up a little bit more, which is only 3% now, or not, the break of the trend line is going to be an objective sell signal. However, I told you, unless I'm really convinced otherwise, I will be very aggressively short, meaning removing hedges and just raw short, the NASDAQ 100 in an aggressive fashion if we happen to get up there. Now, what I want to talk about is how we're going to get there, and that was important because that was in the post from a couple weeks ago. Went on to say, on the bottom line, as far as less than 5% upside potential, as far as timing goes, should SPY and QQQ continue up to the top of those potential market top ranges, my best guess it might only take a week or so based on the recent momentum. Okay, and I maintain that, and so it would be quick. I do not see us kind of meandering on to there over the next few weeks or months. It's either going to be this final capitulation type blow off top. We've started to see that. We haven't seen anything like this in a while. These are the 3 biggest days just since whatever. We had a false intraday, not a false breakdown. I need to clarify that. We never closed below the trend line on a daily or weekly closing basis. I have this trend line on both. And that is in just 4 trading sessions, we went up 4%. That's about 1% a day. We haven't seen that since about right here. That wasn't even 4%. So it's that kind of quick fashion. Now, again, even if the odds go up, what's the RR? And you may have a different outlook on this. So the risk reward to try to gain and go long here, 3% upside, even if the probability now increases the odds we're going to get there. It's just if you're an active, you can do it. The way I would do it too, since it's probably going to be pretty unidirectional. And remember, today's Friday, so whatever you take home today, you have that 2 extra day of overnight risk. So it kind of sucks for that, or makes it a little difficult to go home heavy, long, or short with the risk of a gap down. But if this continues to play out, we'll probably gap up or have a big green day Monday. We'll probably be there by next week, because that's what I said recently. It'll probably be just a matter of weeks before we get there, not months. And again, anything is possible. We could come back to the trend line again and go back up. But again, I think if we're going to hit the top of that range, it's probably going to be next week. And or we take this trend line out, especially a solid daily close below it. Even better to see a weekly close when you toggle over to the weekly time frame, which this is. It's the same trend line. Then those are your targets. And as I said in that post, that the nature of the market, especially with everything I've seen now, the hot air in the market, the horrible market breadth, extremes in put to call ratios and market and sentiment, and then other sectors rolling over, it would probably be a swift move down. And that's been the history of market turns, as the stocks tend to drop much faster than they rise. And again, you can see T1, 2, 3, 4, 5, and 6. And just to update some of the things that I'm watching, and remember I have a watch list called my TTW, or things to watch. Some of those, I showed you how the home builders have long since peaked. One of the stocks in my things to watch is the king of financials, JP Morgan. Somebody mentioned last week, hey, it's looking a little toppy. Absolutely. In fact, I gave it as a trade idea back here on this trend line break and then break of 193.90. We hit my first target, and as expected, bounced. Bounces carried us up to a marginal new high, and I still reiterate these next targets. We're coming off that divergent high. There was we put in, this was a second divergent high right here. We had DH1, DH2, but they're all just one big consecutive divergent high. This is, again, the king of the financials. And I also mentioned KRE is likely topping recently, a couple weeks back. I highlighted it several times. We have a primary downtrend line. This is the regional banks right there. That trend line comes off the beginning of the 2022 highs. We have nice clean reactions, including recently. And so we're pinched here. So what I see here is this downtrend line, which is important, obviously bullish if it gets taken out above. But there's price support here, and I have that red line, which is like a caution line. This part here forms a descending triangle pattern. Again, bullish upside break. Obviously, even more bullish if you take out these previous reaction highs over there. Bearish if you break that. So keep an eye on KRE, regional banking sector. And again, it's another one just sucking wind. And then you have some of my most reliable leading economic indicators, most importantly, ADP. Yeah, again, you can go back in history and look at this. And ADP peaks, the market will peak thereafter. This is, you're hearing about record employment, this awesome job market we have. But if you really read up on folks that know what they're talking about, a lot more than me when it comes to fundamental analysis, that look at things like the birth-death model for jobs creation, which is just a fantasy kind of big guessing game model the federal government uses. This is real time. If ADP, if you have a super strong job market and a stock market all-time highs, I would love to hear someone that, and again, you can do this yourself, go back as long as you want, compare the S&P 500 to ADP and Paychecks, and explain why ADP peaked back here in the end of 2022, and it's still below that. But more importantly, okay, I've talked about that quite a bit. More importantly, and if you recall, it's been a while since I updated it, but I had it in this symmetrical triangle back here a few months ago. Told you upside break would be bullish and downside break would be bearish. We broke to the downside again below this triangle pattern here. And it's not just ADP, it's also its partner in crime, Paychecks. And again, Paychecks, the other big payroll processor, peaking all the way back in early 2022 versus ADP in late 2022. And then a nice clean downtrend line off those highs. And then a nice clean uptrend line, giving you another symmetrical or nearly symmetrical triangle pattern, and a breakdown of that as well recently. So these guys are just singing a different song than what's being reported in the jobs market, because if the jobs market is strong and growing, their profit model goes up. It's simple. It's just it's like Visa and MasterCard. More swipes, they paid every time you swipe. And they also get paid interest when people are behind on their cards, but and you can look there in my things to watch list too. And you have MasterCard peaking back here as highlighted. We broke down, put a sell signal right there on the break of that bearish rising wedge pattern, been walking its way down, hit the 200-day moving averages right here. And I'm going to point out that it does have a lot like the home builders, another one in my things to watch list. I watch that for clues on the coming. You have this positive divergence, so there's a potential. I just showed you home builders at my first target, likely to bounce. MasterCard, Visa. If you're bullish and don't think the market's near a high, these are some of the better looking sectors. However, if this top is in the market, these guys tend to top first. Again, they're my more accurate leading indicators. UPS, FedEx is there as well as. And so you have this positive divergence. And in a bull market, that will almost always, again, let me repeat this. In a bull market, a divergent low on the 60 usually does the trick to be the catalyst for a move to new highs. This is positive divergence on the daily. So for those folks, and we know you're out there, I hear about you every day in the comment section, that this market's going to the moon. These are, I don't know why you wouldn't step in and buy MasterCard and the home builders and Visa here at these 200 days. Now, again, that's if the top is in, then they are going to have a little, or they've already had a little reaction. See, there it is. There's a great example. Here's Visa. They stepped in and bought it at the 200 days. Slight undercut, intradays, 1, 2, 3 days trading, you're above it. So you can look at it this way. They've already successfully defended the 200s. You could still step in and buy if you're bullish. And there's the positive divergence I'm showing you. However, Bigger picture is, these guys, when you look at the weekly chart, Visa finally broke down. This is a primary uptrend line off the 2022 lows. That's the low when the stock market bottomed, October 2022. There's your uptrend line, solid red bearish candle down through there, put on a sell signal. And MasterCard already broke its comparable uptrend line. I can actually add one here. Let me do that now. So we're hair above it in MasterCard. So there's your levels. They're big support right here. So again, if you're bullish looking for a trade in the financial sector, you've got, and it's objective whether you're bullish or bearish or just market agnostic. Go long with a stop somewhat below there. But again, I've showed you where, we're in spitting distance of both SPY and QQQ of what I, pretty solid maximum bounce targets. And so the juice just isn't there, the risk reward for me. But if you're looking for ideas, that's what this site is about. I provide analysis. You click the mouse and place the trades. So MasterCard at support, the home builders at support, 200-day moving averages. I mentioned FedEx, and there's others I have in there, but I mentioned FedEx and UPS. Let me queue those up. Just take a look at those. There's FedEx. This is a weekly. I was already on a weekly time frame. Big divergence building on FedEx. FedEx peaked. Again, go back in time. You're not going to find many, if any, incidents where FedEx peaked, is several years off its high. It peaked back here when the stock market peaked back in 2021. It was November 2021 when the NASDAQ peaked, but this is when FedEx peaked, and it's still below that high. Big divergent high there on the weekly, and right there. So it's made a new 52-week high, but still not a new all-time high. And so we'll see where that one goes. UPS looking much weaker. This is the other big shipping company. And again, they're simple. The reason why they're economic bellwether or indicators, if you will, obviously, if the economy is booming, they're going to be shipping a lot of products and to and from, and when things go down. So you do have positive divergence. I would say better support if you could get it down here. So you could still have divergence if it goes lower. But again, the takeaway is this is a stock in a bear market. This is a stock that peaked in the beginning of 2022. This is what a downtrend looks like. And, it just doesn't mesh. These are long-term, going back as long as these companies existed. And I've done this in previous videos, showed you when the stock market made major turns. These guys turn. They bottom when the market bottoms. They top either usually right before. They're leading indicators. When you see the stock market going up after these guys have peaked, it tells you what's going on. Something's not right. These guys should be going up if economic growth is strong. But we all know that right now, and you've heard that the stock market is not the economy. So it can make sense to see their profits dropping, even if a handful of tech stocks are lifting the stock market due to their unique, almost monopolistic business models. And again, they're cash cows, but then also their stock buybacks. And again, a little AI thing, a little bubble we call AI hype. So that is it, guys. In summary, we are in QQQ about... We're in that range. We're still in the market top range, about 3% below it. SPY, I had it a little bit higher. And again, not just based on all the criteria I showed you earlier, Fibonacci projections, Fibonacci retracements. If we get there, that goes about 5%. So that would, again, if both hit. Now, you don't have to have both hit at the same time. It would be great if they did. But if that does happen, you can see SPY, who is also holding above their comparable trend line. This thing looks like it drifted a little. Let me fix that trend line. There's the uptrend line. And so a little more upside there. That would indicate, if it plays out as such, outperformance on the S&P 500, meaning maybe you start to see the big tech stocks soften a little bit, and you start to see market breadth improve a little bit. Meaning watch the equal weighted index. QQQ is up almost 1% today. QQQE is up 0.72. Same story. S&P 500 is up 0.5%, and the equal weighted S&P is down 0.2%. So that's what the equal weighted looks like. No, there's my levels. All right, let's wrap it up here. I think that's everything I covered. Somebody asked for an update on some ag input stocks. That was in a comment from a post earlier today. I replied, give you 4 charts there. And my thoughts, I think we need to see a little bit more evidence in the sector for a reversal. And if I missed anything else as far as chart requests, just post it under this one, and I'll try to read this later today or tomorrow and get back to you. This has been Randy Finney with Right Side of the Chart. Have a great day.